Hello. In this video, we'll be looking at some practice questions to help you understand the basic concepts properly and help you understand how to apply the concepts of IFRS 15, revenue from contract with customers. The first question that we'll be looking at is, Logitech offers maintenance services to its customers. Previously, it recognized revenue and the cost for maintenance contracts upfront when the invoicing customers at the start of the 2-year contract period. So basically here, Logitech is recognizing revenue the moment they receive the consideration at the start of the maintenance period itself, right? Now in 2008, Logitech acquired Soft System, which recognized revenue for similar contracts on straight line basis over the contract term. Although Logitech felt both methods complied with IFRS 15, it adopted Soft Systems approach across the group. It viewed these as a procedural change rather than change in accounting policy. So here Logitech has acquired another company where it also sells similar maintenance contract but recognizes the revenue over the period of contract on straight line basis. Logitech is under the impression that both the systems are in compilation or compliance with the IFRS 15, which basically is incorrect. For the year ending 31st March, Logitech began recognizing revenue and costs evenly over the contract period, treating this as a change in accounting estimate. This adjustment reduced the year's profit by 4.5 million. Discuss how the above transaction should be dealt with within the financial statements for the year ended 31st December. So you should understand the requirement first and the scenario. Logitech is recognizing revenue for a obligation which is recognized over a period of time, which they are providing over a period of time, and recognizing revenue at a point of time when they receive the consideration at the start of the maintenance period is incorrect. Secondly, they have implemented the change and now decided to recognize revenue over a period of time, but they are doing it prospectively. Now this also is incorrect because this is not a change in estimate, it's a change in policy. Therefore, how to structure your answer? The first thing you should realize or you should mention here that the previous policy for the revenue recognition is not in accordance with the IFRS 15. The provision for maintenance of service meets the IFRS 15 criteria for performance obligations satisfied over the time. One of the conditions here to recognize that the performance obligation is satisfied over time is that the customer is simultaneously receiving the benefits, receiving and consuming the benefits simultaneously. Therefore, that is an indication that the performance obligation is satisfied over time. Therefore, the revenue should be recognized by Logitech based on the stage of completion of the contract at the reporting date. Logitech made the error of recognizing the revenue at the start of the contract period. This change is in the accounting treatment should be presented as a correction in the error as per the accounting standard number 8 and has to be effected retrospectively. The second practice question here is about Technonova, which enters into a contract with customer for supply of laptops worth $800,000. Payment is due 1 month after delivery. Based on the past experience with similar customers, Technonova estimates a 4% risk that the customers may not pay half of the amount owed after receiving the goods. Later, Technonova assesses that the customer's financial condition has worsened and further reduces the trade receivable by $800,000. Required, explain the approach to revenue recognition and measurement under IFRS 15. Now in this case, IFRS 15 applies where there is a contract between the customers, and one of the criteria to recognize a contract is that there is a possibility or that is probable that the seller will able to collect the consideration from the customer from which he is entitled to. Now here the risk is only for 4%. That means Technova considers that there is a 96% chance that the customers will pay. Therefore, the criteria is met and the entity will recognize the revenue once the control of goods is transferred. Now, this will give rise to a receivable of 800,000. But since there is a 4% risk that the customer may not pay 50% of the amount, Technova can apply credit losses approach to receivables. That is, they can recognize an impairment loss in the SOPL itself. How to calculate this impairment? 800,000 is the receivable. 50% of that is at a risk and the risk is 4%. So 800 into 50% into 4%, it will recognize a impairment of 16,000. Subsequently, it is increased due to increase in the credit risk, and therefore the loss allowance must be recognized in the operating category of SOPL. That is the initial 16,000 plus the additional 80,000. The total allowance should be 76,000. Coming to the third practice question here. Nextech sold computer hardware system to a customer and due to the current market challenges has agreed to defer 1.5 million payment until 2 years after transferring the hardware. Explain the approach to revenue recognition and measurement under IFRS 15, revenue from contract with customers. Now, whenever there is a significant time gap between transfer of control and the payment to be received, there definitely will be a financing component. So how do you structure an answer in this case? Where payment is at a much later date from the time control passes to the customer, the transaction has both the sale and the financing component. In the case, the deferred payment of 1.5 million selling price should therefore be discounted at present value in order to arrive at the transaction price. So, using a discounting factor of 5% which is given in the question, we calculate the present value and recognize a revenue of 1.36 million and a corresponding receivable will also be recognized. The interest should be unwound over the credit period of 2 years. So in the first year, the interest that you will recover and will be shown as interest income would be 1.36 million into 5%, that is 68,000 should be recognized as interest income. The second part of the question is, Nextech has also been offering discounts to customers for purchases where payment is made upfront, but the product is delivered after 1 year. So now here it is reverse. We are collecting the consideration in advance, but giving the control or transferring the product after 1 year. A sale was made under these terms and 2.5 million was received. A discount rate of 5% should be applied to all the calculations. So now in this case, we are getting an advance, but the control of the product has not been transferred. Therefore, when consideration is received beforehand, the cash is debited and a contract liability is recognized. An interest expense of 5% on 2.5 million which you have received is recognized and an interest liability of 2.625 million will be recognized at the end of the year. So when the goods are actually transferred at the end of the year to the customer, you will recognize a revenue of 2.625 million. Thank you. Look out for my next video wherein I will be taking a question from the exam style. I'll be taking an exam style question. Thank you.